Let me start with a simple but uncomfortable question. Why are some wealthy families paying millions in taxes every year, while others, just as wealthy, are paying little to none? And no, this isn't about loopholes, offshore accounts, or aggressive accounting. It's about structure. Today, I'm going to show you how high net worth investors legally eliminate or dramatically reduce taxes using energy investments, specialized real estate, and opportunity zones. And more importantly, why most affluent investors never hear about these strategies until after they've already written the check to the IRS. Welcome back to Investing Outside the Box, the show where we challenge traditional financial thinking and help high net worth individuals build portfolios aligned with the real complexity of their financial lives. I'm David Harris, fiduciary, fee-based advisor, and for decades I've worked with business owners, executives, and affluent families who eventually all ask the same question. Why does my portfolio grow, but my tax bill keeps growing faster? Today's episode is about answering that question and giving you a framework to fix it. Most wealthy investors believe taxes are inevitable. They assume the best they can do is reduce taxes slightly, harvest losses, donate appreciated stock, defer income. But here's the truth. High net worth investors don't lose wealth only during market downturns. They lose it predictably, quietly, and permanently through taxes, capital gains, ordinary income, state taxes, net investment income tax, estate erosion. And traditional portfolios, stocks, bonds, ETFs, offer almost no built-in tax defense. They grow on paper and bleed every April. That's where advanced tax strategies come in when implemented correctly. Let's start with energy investments. The U.S. tax code aggressively incentivizes domestic energy production. Sophisticated investors understand this and use it intentionally. Certain energy investments generate substantial first-year deductions, often offsetting a significant portion, sometimes more than, the amount invested. This means high ordinary income can be offset. Current year tax liabilities can be dramatically reduced or eliminated. Investors retain ownership in real productive assets. This isn't about speculation. It's about redirecting tax dollars into assets instead of surrendering them. For the right investor profile, this strategy alone can materially reshape their tax picture. Now let's talk about real estate, because this is where most investors underestimate what's possible. Here's a real-world case study. An accredited investor allocates $500,000 into a specialized real estate strategy utilizing cost segregation, accelerated depreciation, bonus depreciation components. In the first year alone, that investment produces approximately $1.25 million in depreciation deductions. Let me repeat that. A $500,000 investment generates 2.5 times the investment amount in write-offs. Those paper losses can be used, depending on investor profile and structure, to offset passive income, in some cases, active income, and capital gains from other assets. Meanwhile, the property continues to generate income. The underlying asset appreciates. Cash flow is not reduced, only taxable income is. This is why sophisticated investors don't ask, "What's the return?" They ask, "What's the after-tax return?" Now let's talk about one of the most misunderstood and powerful strategies available today: opportunity zones. Imagine you sell a business, a concentrated stock position, or real estate, and trigger a large capital gain. Instead of immediately paying that tax, you reinvest the gain into a qualified opportunity zone investment. Here's what that can mean: immediate deferral of capital gains taxes, reduction of the original gain, often by 40 to 50%, depending on structure and timing. And after a 10-year hold, any appreciation on the opportunity zone investment can be completely tax-free. That's not tax deferral, that's tax elimination on future growth. For investors with liquidity events, this strategy alone can mean millions retained instead of surrendered. So why doesn't everyone do this? Because these strategies don't live inside traditional brokerage platforms. They require accredited investor status, proper structuring, due diligence, coordination with tax professionals, and a fiduciary advisor who understands how these pieces fit together. Most advisors aren't trained here. Most investors aren't educated here. That's the gap. If you're a high net worth investor paying 6 or 7 figures in taxes each year, Here's my question to you. What would your financial life look like if those dollars were working for you instead of disappearing forever? I offer a complimentary 20-minute consultation where we review your tax exposure, identify which strategies may be appropriate for you, and determine whether energy, real estate, or opportunity zone investments fit your situation. There is no cost, no obligation, just clarity. Visit our website and schedule your free 20-minute consultation today. Because the goal isn't to earn more, it's to keep more, protect more, and control more of what you've already built. I'm David Harris, and this is Investing Outside the Box.